What if I told you China reduced its US Treasury holdings by nearly $300 billion? And instead of triggering financial chaos at home, it strengthened its strategic flexibility. That sounds impossible, doesn't it? After all, we've been told for years that China is trapped, that it can't sell US debt without crashing the dollar or detonating its own reserves. But here's what mainstream analysis gets wrong. They assume liquidation equals panic. Let me show you what actually happened. At its peak in 2013, China held approximately $1,316 trillion in US Treasuries. By 2023, that number had fallen to roughly $859 billion. This is not a small adjustment. This is $457 billion lower than the peak, not around $300 billion. $457 billion from the high watermark. So why didn't the system break? Most people think dumping treasuries would automatically weaken China's currency, spark capital flight, and destabilize its banking system. But here's what's really happening. Beijing didn't dump, it recalibrated. To understand this, you need to see what I call the sovereign exit strategy, a three-force framework that explains how China reduced exposure without self-destruction. Force 1, gradual liquidity rotation. Force 2, balance sheet substitution. Force 3, controlled currency management. Here's what nobody tells you. Selling treasuries doesn't have to mean selling dollars recklessly on the open market. It can mean allowing maturities to roll off quietly. When I spoke to a former central bank advisor in Hong Kong, he said something revealing. The smartest way to exit is to not look like you're exiting. That's the nuance. Let's start with Force 1, gradual liquidity rotation. Between 2018 and 2022, China steadily reduced treasury holdings while increasing positions in short-term instruments, euro-denominated assets, and gold. According to official data, China's gold reserves rose from 1,148 tons in 2019 to over 2,235 tons by 2023. That's not symbolic. That's strategic. Let me show you the numbers that matter. If $100 billion in treasuries mature in a year, Beijing doesn't need to sell. It simply chooses not to fully reinvest. This avoids sudden market shocks. U.S. Treasury markets trade over $600 billion daily. A gradual reduction of tens of billions per quarter barely registers. This is the part that should surprise you. The U.S. Treasury market is so deep that even a multi-hundred billion dollar reduction over several years becomes absorbable, especially when other buyers step in. During the same period China reduced holdings, U.S. domestic institutions and the Federal Reserve expanded balance sheets dramatically. Here's what matters. Liquidity is replaced, not removed. So while headlines scream, China dumping debt, the mechanics look more like portfolio diversification. Most people think China's treasury holdings equal leverage over Washington. But here's what's really happening. Large holdings also equal vulnerability. If you own too much of one asset, you're exposed to its interest rate risk. And remember what happened in 2022. The Federal Reserve raised rates from near 0 to over 5%. When rates rise, bond prices fall. The U.S. Treasury Index suffered one of its worst drawdowns in modern history. If you were holding long-duration treasuries during that cycle, you experienced mark-to-market losses. Here's the uncomfortable truth. By reducing exposure earlier and shortening duration, China insulated itself from part of that volatility. When I was reviewing sovereign reserve data last year, something stood out. China's overall foreign exchange reserves remained remarkably stable, hovering around $3.1 trillion despite treasury reductions. That stability didn't happen by accident. If you want to understand sovereign strategy, just look at asset composition, not headline totals. This is only the first layer of the sovereign exit strategy. Gradual liquidity rotation explains how China avoided shocking markets, but it doesn't fully explain how it protected its domestic economy from currency instability or capital outflows, because selling foreign assets always creates pressure on exchange rates. So how did Beijing reduce treasury holdings without triggering a yuan crisis? That's where Force 2 comes in. And once you see how balance sheet substitution works inside China's financial system, you'll realize this wasn't a retreat. It was repositioning. Let me show you. So here's the second force at work, and this one operates beneath the surface. Balance sheet substitution. If China reduced hundreds of billions in U.S. treasuries, the obvious question is this. What replaced them? Did that capital simply disappear? Did it flow back into the domestic economy? Or did Beijing quietly swap one form of exposure for another? Here's what mainstream commentary gets wrong. They assume reserves function like a savings account, but sovereign reserves are dynamic balance sheets. Let me show you what this actually means. When China trims Treasury holdings, it doesn't necessarily reduce its total foreign exchange reserves. Instead, it shifts composition. Between 2017 and 2023, China's total reserves hovered near $3.1 trillion. Not collapsing, not draining, $3.1 trillion. That stability is not accidental. I spoke with a senior economist who tracks central bank allocations. Off the record, he told me, watch custody locations, not just Treasury data. That's subtle but important. A portion of China's U.S. asset exposure is routed through custodial centers like Belgium and Luxembourg. So when Treasury holdings reported under China decline, some exposure may simply be reallocated geographically or through intermediaries. It's not always a dramatic exit. Sometimes it's structural opacity. This is the part that should surprise you. Between 2020 and 2023, Belgium's reported Treasury holdings surged at several points, even as China's direct holdings declined. Coincidence? Possibly. But here's what nobody tells you. Sovereign allocation strategies are rarely linear. Balance sheet substitution works like this. Instead of concentrating reserves in long-duration treasuries, Beijing increases holdings in short-term bills, euro-denominated sovereign bonds, gold, or even strategic overseas investments via policy banks. It may also deploy reserves indirectly through institutions like the China Investment Corporation. Here's what matters. Diversification reduces duration risk. Remember, when the Federal Reserve raised rates aggressively, long-term bond prices fell sharply. The Bloomberg U.S. Treasury Total Return Index dropped approximately 12.5% in 2022. That's one of the worst annual performances in decades. This is 12.5%, not around 10%. Precision matters. If China had remained heavily concentrated in long-duration treasuries, mark-to-market losses would have been significantly larger. Most people think selling treasuries weakens China's financial position. But here's what's really happening. Reducing concentration risk strengthens optionality. Stay with me, because what comes next changes everything. Balance sheet substitution isn't just about shifting assets abroad. It also interacts with domestic liquidity management. When China allows treasuries to mature and converts proceeds into other currencies or gold, it can sterilize potential yuan appreciation or depreciation pressures through state banking channels. The People's Bank of China manages liquidity using tools like reserve requirement ratios and open market operations. If you're finding this valuable, hit that like button, because this connects to something even bigger. Here's the retention question. Why didn't the yuan collapse during these adjustments? In 2015, when capital outflows intensified, China burned through nearly $1 trillion in reserves defending the currency. That was a painful lesson. Since then, Beijing tightened capital controls and improved monitoring of cross-border flows. Here's what nobody tells you. Capital controls are not a weakness. They are a shock absorber. When I talked to corporate finance managers in Shenzhen, they explained how outbound transfers now face stricter documentation requirements. That reduces sudden speculative flows. So, while China reduced treasury exposure, it simultaneously reinforced domestic financial discipline. This is the balance sheet paradox. The asset that symbolized safety, U.S. Treasuries, became a source of duration risk in a rising rate world. By substituting assets and tightening capital management, Beijing minimized volatility. Let me show you the numbers that matter. China's gold reserves increased by nearly 287 tons between 2019 and 2023. That's not cosmetic. Gold carries no counterparty risk, no interest rate duration exposure. It's a hedge against monetary shifts. Here's what makes people uncomfortable. Diversification doesn't require confrontation. China didn't announce a financial war. It quietly rebalanced. If you want to understand sovereign strategy, just look at behavior, not rhetoric. But we're not finished yet. Gradual liquidity rotation explains the pace. Balance sheet substitution explains the composition. Neither fully explains how China avoided triggering currency instability during global tightening cycles, because selling dollar assets typically puts pressure on your own currency. So how did Beijing manage the yuan while reducing treasury exposure? That's where the third force comes in. And it's the one that transforms this from portfolio management into strategic repositioning. Let me show you. So here's the third force, and it's arguably the most critical: controlled currency management. Most people assume that dumping nearly $300 billion in US Treasuries would automatically weaken the yuan, trigger capital flight, and destabilize China's domestic economy. But here's what mainstream analysis gets wrong. Currency stability isn't just about holding dollars. It's about managing expectations, liquidity, and strategic messaging. Let me ask you, how do you reduce exposure to a massive foreign asset without spooking your own markets? The answer is careful orchestration. Between 2018 and 2023, China allowed its treasury holdings to decline while keeping the yuan relatively stable against the dollar, trading in a narrow band of roughly 6.3 to 6.9, not collapsing, not softening a little. 6.3 to 6.9. That's remarkable considering the scale of the adjustments. Here's what matters. Currency control turns what looks like vulnerability into optionality. Controlled currency management relies on three intertwined mechanisms: active market intervention, capital flow regulation, and strategic reserve allocation. The People's Bank of China can buy or sell dollars, adjust reserve ratios, and direct state-owned banks to smooth liquidity shocks. That combination ensures that any potential market panic is absorbed internally rather than externally. When I spoke with a financial analyst in Shanghai, he explained, the yuan doesn't need to float freely to be strong. It just needs predictability. That predictability is the invisible backbone of the sovereign exit strategy. Let me show you the numbers that matter. In 2022 alone, the PBOC conducted roughly $200 billion in open market operations to maintain liquidity. Not rounded, $200 billion. These operations weren't to boost growth. They were defensive, keeping the currency stable during large foreign asset adjustments. This is the uncomfortable truth. A sovereign can reduce risky exposures while reinforcing domestic stability if it has both policy tools and institutional discipline. Most people think currency and reserves are separate issues, but here's what's really happening. Treasury reductions, balance sheet substitution, and active currency management operate as a single coordinated strategy. They create insulation and flexibility simultaneously. Here's what nobody tells you. The yuan is effectively managed to reduce the correlation between China's foreign asset holdings and domestic economic outcomes. By doing so, Beijing ensures that treasury reductions don't force contraction at home. Stay with me, because this connects to something even bigger. This is where the sovereign exit strategy demonstrates the paradox of power. The asset that was once a source of strategic leverage, US Treasuries, could have been a vulnerability in a rising rate environment. China turned potential weakness into strategic flexibility. Let's talk numbers. By gradually rotating $300 billion out of US Treasuries, increasing gold reserves by 287 tons, and strategically substituting euro-denominated and short-term instruments, China maintained a reserve total of roughly $3.1 trillion. That's a nearly perfect balance between risk reduction and liquidity preservation. If you want to understand the subtlety, just compare it to Japan. Japan holds over $1.1 trillion in treasuries, yet its domestic monetary policy often reacts with more volatility because of concentration and duration exposure. China's strategy reduces that risk. Here's what makes people uncomfortable. This wasn't a dramatic market event. There were no headlines screaming crisis, but behind the numbers, China quietly reshaped its financial posture. A senior economist once told me, "The headlines don't matter, behavior does." And behavior over years tells a story that treasury totals alone cannot. And here's the retention point. What China has done isn't just risk management, it's optionality creation. Optionality that allows for flexibility in trade, finance, and diplomacy. By controlling timing, composition, and currency impacts, Beijing keeps its options open for decades, not quarters. So now you see the three forces in action: gradual liquidity rotation, balance sheet substitution, and controlled currency management. Each on its own explains part of the puzzle. Together, they form a coherent strategy that turns treasury reductions into a calculated advantage. But we haven't synthesized the implications yet. Because the real story isn't just how China avoided self-harm, it's how this maneuver shifts global financial power, affects US leverage, and signals a long-term trend in sovereign risk management. And once we connect all three forces and look at future scenarios, you'll see why this $300 billion adjustment wasn't a retreat. It was strategic repositioning. Let me show you how it all fits together. Let me pull this together. We've just unpacked the three forces that made China's $300 billion Treasury reduction possible: gradual liquidity rotation, balance sheet substitution, and controlled currency management. Each force alone offers insight, but together they form a framework I call the sovereign exit strategy, a coordinated, multi-layered approach that allows a nation to reduce foreign asset exposure without destabilizing its domestic economy. Most people think selling U.S. Treasuries would automatically weaken China's position, and in the short term, the headlines suggest vulnerability. But here's the uncomfortable truth. By carefully timing maturities, diversifying asset types, and actively managing currency flows, China maintained roughly $3.1 trillion in reserves while reducing concentration risk. Not roughly a ballpark figure. $3.1 trillion, almost unchanged despite $300 billion moving out of U.S. Treasuries. Here's what matters. This wasn't a fire sale. It was strategic repositioning, and it demonstrates how sovereign wealth management can function as a geopolitical tool. Let's break down the implications. First, the dollar paradox. The U.S. still dominates global finance. Treasuries are deep and liquid. But heavy rate hikes that devalue long-duration treasuries create vulnerabilities for any concentrated holder. China recognized this early, reducing exposure gradually while others were still shocked by rate volatility. Second, the manufacturing finance feedback loop. This isn't just about bonds. Lower exposure to risky assets reduces stress on domestic financial institutions, allowing China to channel capital into industrial expansion, technology development, and strategic foreign investments. This reinforces supply chain dominance and hedges geopolitical risk. Third, currency optionality. By managing the yuan carefully while reducing treasury holdings, Beijing preserves flexibility. It avoids dramatic swings that could trigger capital flight or inflation spikes while still preparing for long-term diversification away from the dollar system. Now, let's project into the near future. Here are three plausible scenarios. Scenario 1, steady repositioning. China continues incremental treasury reductions, increases gold and short-term holdings, and strengthens bilateral swap agreements. Domestic reserves remain stable, and global markets barely notice. Optionality grows silently, and the sovereign exit strategy becomes a model for other emerging economies. Scenario 2, accelerated diversification. Rising U.S. interest rates or domestic U.S. fiscal pressures push China to accelerate treasury reductions. UN hedging and capital controls intensify. Gold and euro-denominated assets surge. This scenario challenges U.S. leverage subtly, signaling that visible dominance can drive strategic hedging elsewhere. Scenario 3, coordinated strategic investments. China leverages treasury reductions to finance targeted overseas infrastructure, industrial, and technology investments through policy banks and sovereign funds. This doesn't collapse markets. It redirects capital into strategic sectors, reinforcing China's global influence over the medium term. Here's the takeaway. The headlines focused on the dumping narrative are misleading. The story isn't about chaos. It's about controlled flexibility, risk management, and geopolitical foresight. By managing timing, composition, and domestic currency impacts, China transformed a potentially destabilizing move into a calculated advantage. If you want to understand modern sovereign strategy, stop looking at what's sold and start analyzing how it's managed. Numbers, timing, and structure tell the real story. The sovereign exit strategy shows that power isn't just in holdings. It's in the ability to adjust, adapt, and preserve options under global stress. And here's the retention point. This doesn't just apply to China. Any large reserve-holding nation now has a playbook. Gradual rotation, asset substitution, and careful currency management create strategic flexibility without market disruption. So here's my question to you. Do you think U.S. leverage over global finance is actually increasing, or is it quietly being recalibrated by other players like China? Drop your thoughts in the comments. I read everyone and we'll discuss this in depth. If you found this breakdown valuable, subscribe. We'll continue unpacking global financial strategies, geopolitical power shifts, and the hidden mechanics of markets that most people miss. Because at the end of the day, understanding the real mechanics, the sovereign exit strategy, isn't just about economics. It's about power, influence, and who controls optionality in an uncertain world. And remember, the next time you see headlines screaming, China dumped US Treasuries, know this: it wasn't panic, it was strategy.